Welcome to the Mortgage Wise radio show and video podcast, where we educate and provide expert advice on personal finance, mortgages, and real estate investing.
Show me the money.
As a result of what we do, our team has helped hundreds of first-time buyers, experienced buyers, and real estate investors achieve their goals of home ownership.
I wonder if there's a connection there.
Here are your executive producers and mortgage advisors, Randy and Veronica Chambliss.
What up, everybody? Welcome to another episode of the Mortgage Wise radio show. I'm your host, one of your hosts, Randy Chambliss. Excuse me, I just drank some water, went down the wrong way.
Right when we go live.
Right when we go live. So having said that, guys, I'm the executive director of Louisiana Housing Authority. I'm a corporate branch manager with Geneva Financial. I'm an investor, a speaker, financial educator, right? And we teach responsible home ownership. And I have to my right.
I am Veronica Chambliss. I am the housing director at Louisiana Housing Authority. And I'm also a corporate branch manager with Geneva Financial. So I want to welcome everyone to episode 28.
28. Yes, we rolling.
So it's been 6 months.
Yes, it's a long time.
Yep.
Commitment, guys.
That's right. So today we're going to discuss the new FHA student loan guideline for home loans and money habits intervention. So with that being said, I am super excited with the new changes that HUD has made for FHA loans, because in the past, so many borrowers, they wasn't able to accomplish their goals, whether it was to purchase a new home or refinance their home to take advantage of the low interest rates, because the student loans was so high. And we had to go under the guidelines at that time with 1% of the outstanding balance. So I'm excited because today I was able to help one of my clients start her refinance on her home so she can take advantage of the low interest rate. Plus, she's dropping her PMI.
What?
Oh, yeah.
Tell people what that PMI is real quick.
So that is private mortgage insurance. That's an extra payment that's inside of your mortgage every month. And it goes towards this pool that the investors have to help other people to finance homes too with a lower down payment. But this lady, she has enough equity in her home, and we're going at this time to be able to help her refinance.
Yep, so. Awesome, guys. So that's critical, because sometimes private mortgage insurance or PMI, it could be $100 or more sometimes. It could be less, right? But that's an extra money. That's extra money that's in your escrow that really doesn't serve you personally, right? It serves your mortgage provider, right? Your mortgage servicer. So if you default on your loan, they will tap into this private mortgage insurance policy that you've been paying on their behalf to be able to try to make themselves whole if you default and you have to foreclose. But when you have at least 20% worth of equity in your property, that can drop off. And that's the reason why Veronica is so excited, because her mortgage payment is going down, her interest rate is going down, all because her student loans was able to be adjusted by these guidelines we're getting ready to share.
Yep, absolutely. So we're going to read directly from HUD, and that's the Housing and Urban Department. So what their guideline states is, if the payment used for the monthly obligation is less than the monthly payment reported on the borrower's credit report, the mortgagee, which is the lender, must obtain written documentation for the actual monthly payment, the payment status, and evidence of the outstanding balance and terms from the creditor or student loan servicer.
Absolutely. And, we want to, I always say documentation beats conversation, right? So we getting this directly from HUD, right? So that's a documented document. You can go research, Google that yourself, because we want to make sure you have an understanding on what this actually means, right? So let's break that down. So as a lender, when we pull your credit report and we see all the expenses that's going out every single month, right? Because we are doing a debt to income ratio, right? We are doing a ratio, a calculation based on the income that you have coming in that you prove through your paycheck stubs or through your W-2s, or if you're self-employed through your tax returns and profit and loss statement, right? So it's proven to us how much income you have coming in. But what proves to us what your monthly living expenses is, we look at your credit report. Now, we're not looking at things like your cell phone bill, your light bill, insurance, water, gas bill. We're not internet bills. Like, we're not looking at those items, but items such as credit card payments, personal loan payments, auto loan payments, other mortgages that you may have, and also student loans, right? And so what that is basically saying, when we pull your credit report and we see that lender actually sees the individual that have that student loan, it's going to give us a payment, right? Might. Sometimes it says zero. Oftentimes it will actually have a payment, right? And what it's saying is that if that payment is, I don't know, $50 a month, right? Then we can use that $50 a month for your expense monthly to calculate into your debt to income ratio, right? That's what that's saying, right? Now, at the same time, if you do not have, well, before we go, let's go to the next section. I'm getting ready to spoil it real quick, right?
Going on. All right, so it says for outstanding student loans, regardless of payment status, the lender must use the payment amount reported on the credit report or the actual documented payment when the payment amount is above zero.
Right. So what that breaks down to, if we look at that credit report and is a zero monthly payment on there, then we have to have a calculation that we do based on HUD guidelines. That's going to be the next point. But if there's an actual payment there, we can use that payment for your calculation. It's on the report. But let's say that the monthly payment on your report is $300 for your student loan. Well, if you have something in writing directly from the student loan company that's on a company letterhead, then we can, as a lender, we can use that letter on the company letterhead, right? That says what that balance is and what that monthly payment that they negotiated with you is. So let's say if it's $100, right? And it's less than what's on your credit report, then we can use that $100 for your monthly mortgage, for your monthly debt expense.
Right, yep. Or we can use 0.5% of the outstanding loan balance when the monthly payment reported on the borrower's credit report is zero.
Yes, and what does that mean? Well, let's say if you have $50,000 worth of student loan that's showing up on your credit report and there's zero balance, right? Then we have to put an expense, monthly expense toward that. In the past, FHA forced lenders to use 1% of the outstanding balance. So in our example, a $50,000 student loan, 1% of that is $500, right? Mm-hmm. Oftentimes we might get people that might tell us they have $100,000 in student loan debt. Then that is a $1,000 monthly debt payment expense that we have to calculate, right? And what that does, well, that makes the debt to income ratio really high, and it kicks individuals out of qualification for a home loan purchase or a refinance, right? And so that's why that's super critical.
Yeah. So under the new guidelines, so a payment, a $50,000 student loan outstanding balance would be $250. $100,000 balance would be $500.
Right. It's half of that 1%, right? Yep. So that's a significant difference before.
That's right.
And then also before, what FHA guidelines that was in place, it didn't matter if you had a letter from your student loan company on a company letterhead that states what your mortgage, what your student loan debt payment is monthly. If you had it, it didn't even matter. The guidelines state that you had to use, or you have to use 1%. So that is the big change that FHA brought down. And what this does, this stimulates more home ownership, right? Right. You have a lot of people that just have a lot of student loans, but the income was low, or they had an auto loan on top of it. So they just could not qualify. So this opened up a pool for individuals in the past that could not qualify based on their student loan debt to get themselves in a position to be able to finally purchase their home.
That's right. And I got to go back and correct myself, because see, I got overly excited. Like I said, I am excited. But my client that's refinancing now, we're not dropping PMI. I done got her clash with another client.
No, I got you.
But she can refinance now, because now we're using 0.5% of her student loans. So she's going to refinance that and take advantage of a lower interest rate, which in turns will be lowering her monthly payment.
Absolutely. I mean, right now we have some of our past borrowers that we did consultation with. We do free consultation. Individuals give us a call. We find out what their goals are, what they want to achieve in life, right, in regards to their home ownership. And we hear them out. We ask them questions. And then if they're ready to move forward, we're going to give them the blueprint to move forward. We're going to start their loan application. If they're not quite ready to move forward, we're still going to give them a personal game plan, right? So they're going to know exactly what they have to do to be able to, in the future, be able to qualify. So some of our borrowers that we had conversations with in the past that couldn't qualify based on the student loan debt, now they're reaching out to us and saying, hey, can you tell us about these guidelines, right? What it looks like, right? And so that's why we wanted to certainly take advantage of this platform of the Mortgage Wise radio show and video podcast, because this was about being wise with mortgages, right? So we want to disseminate this information to you guys. So, Veronica, let's just share a couple of stories, right? Like I had an individual that gave me a call. We always, taking these phone consultations. So I'm just randomly picking a couple, right? Individual have, $100,000 worth of student loan, $150,000 worth of student loans, right? And they know that in the past, through reading, that it might be a challenge for them to overcome. Well, now at this point in time, we can reevaluate that because the guidelines have changed. That person may have that letter that's written on a company letterhead already in place with a lower monthly payment, right? Or their credit report actually have a payment that we can actually use for that. So it's, I'm excited because it just opened up a pool for individuals. And I should, also clarify, like, what is a FHA loan, right? You hear a lot of people make some mistakes in giving an answer to it. You'll hear things like, well, it's for first-time home buyers, right? Or you may hear something like it's a government loan, right? Well, those two statements or answers are not quite correct, right? FHA is a loan product. That's what it is, that lenders use, bank use. And what happens is the government, right, say, listen, we're going to back that loan, right? We're going to back that loan. So in case that this borrower default and can't pay their mortgage and you have to foreclose, right, we're going to step in and back it up. We're going to help soften some of that hard fall from that default, right? So that's what the FHA is. It's basically from HUD, it backs the lenders up to be able to provide home loans to individuals that may not qualify for conventional, right? So conventional loans, you have to have a certain credit score. On a conventional loan, your back end debt to income ratio, that ratio we were talking about earlier, could be about 45%, right? Versus a FHA loan, that back end ratio could go up to, in some cases, 57%, 56% on the back end, right? So that's a big difference. What that looks like in numbers. Well, you may have an individual that have some debts that they have, income coming in, and the calculation may be maxed out at 56% for FHA. Well, that might equate to a $225,000 home loan, right? But if you go conventional and it's scaled down to 45% back end ratio, that may even only leave you at $125,000 home loans, right? So that's kind of like the big difference. Also, conventional, in some cases, don't like collection accounts, maybe a late payment that happened a couple of years ago. Certain little small things like that, conventional loans don't like, right? But FHA, they give you a little leeway, a little cushion, a little forgiveness, a little mercy, if you will, right? And they allow you to qualify with that collection or with that medical collection, et cetera. So it's a huge difference between FHA and conventional and some of your other products. But I wanted just to share that wisdom with you guys, because no, it does not, you don't have to be a first-time home buyer to use an FHA loan, and no is not a government loan, right?
So in order to take advantage of an FHA loan, it has to be your primary home, not investment property. So anybody can get an FHA loan as long as you're living in the property.
Absolutely. So you may have an FHA loan when you first purchase your starter home, right? It might have been a 3-bedroom, 2-bath. You may not have been married, or you may have been married, but you may not have any children at the time. But now, later on, 3 years, 5 years, 10 years down the road, you have a family that expanded. Now you have one child or a couple of children, right? So now you want to go from a 3-bedroom, 2-bath home, 1,200 square feet. Now you want a 4-bedroom, 2.5 home, 2,500 square feet. Well, you can upgrade, right? to be able to get yourself into that new home if it makes sense.
Right.
Just like we just referred to, it makes sense, but it got to be your primary home, right? Some cases you could refinance out of the FHA loan that you currently had into a conventional loan, and now you're moving out, rent the other property out, and you're moving out to your new home if it makes sense, and now you can obtain another FHA loan. Why is that important? Because FHA requires only 3.5% down for your down payment, right? That's a big difference.
Yep, that's right.
So having said that, we're going to change gears just a little bit, and we're going to talk about the topic money habits intervention, right? Money habits intervention. So it's kind of like, I want you to think about this for a moment, right? You have someone that might been dibbling dabbling with drugs, and they became sober, right? And so they had to go through some intervention, right? To find out what's going on in the psyche, right? What's going on in the program that allow them to get on drugs and be addicted to drugs, right? That intervention is there. And so oftentimes that's what happens with money, right? Money could be a drug for somebody. It could be addictive to some people, right? Meaning that you get some money and the first thing you do, you go and spend, right? A spendaholic, right? You have to buy that new car. You have to buy the new purse that came out, right? The new Jordans, right? Whatever the case may be, money flows in and money flows right out of your family bank account. And so some people need that money intervention, like including myself when I was younger, right? I tell my story all the time. I was 24, 25 years old when Hurricane Katrina hit. I was making really good money, but it was going right out the door. I was spending really good money. And when Katrina hit, I had less than $500 in a bank account. My credit score was horrible. It was in the low 500s, and it was horrible. People from businesses used to call my house. My children answered the phone and say, "My daddy said he's not home," right? So I found out really quickly how to get back on my feet. And that was the mystery call payments, right? So I understood that, right? And I understand that today. And a lot of people is in that position, right? Telling a story about a young man, he was in his early 20s, right? He had some cash coming through a lawsuit, right? And he probably had about 20,000 or so that was coming to him. And right before the money came to him, maybe a week before that, he ended up going and buy a car, right? Not a brand new car, maybe 2-3 years old car, but the car was $26,000, right? Interest rate, 15-16% interest rate, right? Next thing you know, the car note is about $800 plus a month, right? Week and a half later, boom, the money come in, right? When he could have used some of that cash and need to pay it off that car real quick, or just waited to buy a car cash, right? But he decided instant gratification, right? That microwave society, right? He decided that I wanted this car now because I deserve it, right? I'm working every day. I'm getting up at 5:30 in the morning, leaving out the house at 6:30, going clock in for 7 o'clock. I want what I want, right? And then you had other people in his environment.
Other people supporting the bad habit.
Right.
Yeah, you deserve it. Go get it.
That's right. You doing good, right? Yeah. So he went out there and got in debt, right? Young age, early 20s, doing debt. Not only that he bought one car, then he turned around about a month later, go buy a second vehicle for a friend, right? Co-sign for a second vehicle for a friend, another $800 car note. So think about that. Now this young man in his early 20s, right? Early 20s, 2 major car notes, $800, right? Obviously spent all the money that he has through that lawsuit because he didn't make no investment. So that money's gone. So now he's stuck right now paying these car notes, right? So what happens? Well, now he's a slave to debt. People think that slavery is over with. Listen, I want to be just in a little bit in your face, no disrespect, right? But if you owe somebody and you are a debtor, right? And you are a borrower, right? Then one of my favorite books say that you're a slave to the lender, right? So if you're a slave to the lender because you have so much debt, that means you have to go to work every day. You have to go and pull that overtime, right? And it's so bad, some people go pick up a second job or third job, and the idea is to help pay down their debt, but they create a lifestyle around the second and third job. Now they're stuck in this hamster wheel, right? And so we want to talk a little bit about that. Financial objectives, like what are your financial objectives, right? One of your objectives most likely is going to be that you want to go to work today, pay your bills, what you owe, and have money left over so you could go spend and do what you want to do, right? Put some money in the savings. You want to be free in that nature. Yeah. The second financial objective is at some point in the future, you want to retire and don't have to go to work for nobody, but still maintain your lifestyle that you create. So your financial objective is basically your lifestyle. Like, what lifestyle do you actually want to have? Like, do you see yourself working 2-3 jobs for the rest of your life? Right? You go to work to pay bills and just die? Is that your financial objective? Right? But when you put yourself in a position of debt, right? Having debt, more debt, because of what? Instant gratification, the feel-good emotional state that it gives you, right? And we all know, we've been there. You get something new, maybe that new car, the leather smell good for the first month until that first note come around. Like, the leather don't smell the same.
You know what? Turn this sucker in.
Right. The leather don't smell the same no more. So, I want you guys to think about your future lifestyle. Like, what do you want? Like, choose your future. Decide how you want to live. Do you want to live a lifestyle where your debts are gone? Your living expenses is super low, and you have cash flow coming in from multiple streams of income on a continuous basis? Life is good. Trust me. Life is good on this side. Like, I've been broke and busted and disgusted. I hit rock bottom before. It ain't no fun, right? I'm telling you, right? I'm telling you what I know, not what I experienced, right? I mean, I'm telling you what I know and experienced, not what I didn't read in a book, right? So next, right? What's the next, Veronica? Let's give you.
Next is to focus on financial education and planning.
Yeah. So let's look at the financial education and planning. What do financial education mean? Well, that's 6 words that you want to be familiar with. That's number 1, income, expenses, asset, liability, and cash. And the last word is flow, right? Those 6 words that you want to master, right? Income statement, balance sheet, you want to know, right? We sing a song with our children and they got it in their brain. Hopefully, we've been trying to program with that. Assets put money into your pocket, right? And liabilities take money out of your pocket, right? That simple concept will allow you to have that lifestyle or obtain and achieve that lifestyle that you want to live, right? So that's what the financial education is. You need to know those type of terms, right? You got to know what that is, right? You have to be focusing on buying assets, right? If it's not an asset, if it's not going to give you a return on your money, then you want to rethink that, right? Now, granted, let's go back to the story of the young man that bought those 2 vehicles. Those are liabilities for him, because why? Every single month it takes money out of his pocket, from maintenance to gas to insurance. By the way, is the 8-cylinder, right? The V8, right? Sucking up a ton of gas, right? And so you got gas, you have insurance expenses. Why? Because he's young, he's in his 20s, right? So he got a high insurance. Now you have a 15% interest rate, 16% interest rate. So that is a liability. But what if he had a business, a ride share business, right? Where he picking up clients and clients are paying him to pick them up. Now that's a different ballgame, right? That is an asset that is going to not only pay for itself every month, the vehicle I'm referring to by itself, but now money is left over for him to live, cash flow, right? So we have to know the difference between the two. Planning, right? You have to plan. My mentor told me a long time ago, I hold on to this day and I teach it. Plan your work and work your plan, right? You have to have a financial plan. And it starts with, what do you want? What is the lifestyle you want to live? Most people never plan their future, right? And oftentimes they don't plan because they are afraid of what the outcome is going to be. They look at their current situation right now, where they're living at right now, the debts that they have, the high living expenses they have, the low income there, and they look at it right now and say, I don't want to plan, I'm afraid. Then they start to make decisions, future decisions based on their current situation. Then they look at their past mistakes and their past challenges they had to go through, and they base their future decisions based off their past. Well, here's a little intervention, right? You are where you are today financially, right? Or in any area of your life because of the decisions and the actions you took 3 hours ago, 3 days ago, 3 years ago, right? So that's where you at today. In the past, those past challenges you had to go through, you went through that because of decisions you made prior to that. But today is a new day if you choose to. If you choose to be born again and make this day the first day of your new life. Meaning that now today, you're going to make different decisions today. You're going to apply. It's not good just to have financial literacy or to obtain financial education, but you have to apply it. That's what wisdom is. Apply it. Actually put it into works, put it into action. Faith without works is what? Dead. You have to put in the work. And so now you make a decision, you follow, you're written down your plan, and you're following your financial plan. And I guarantee you, in the future, your life is going to look different because it must. Why? Because you've taken different actions. You cannot continue to do the same old thing in the same old way, expecting what? Different results. That's unrealistic. You have to pivot. You have to make some adjustments. You have to be willing to participate in your own rescue. And I get it, guys, sometimes, right? I get it. The pain doesn't hurt enough yet. I get it, right? I learned a long time ago when opportunity and dissatisfaction cross paths, there will be a change. But the two have to be there. Opportunity and dissatisfaction. If the opportunity there and there's no dissatisfaction, you're not dissatisfied, you're not going to change. But if the opportunity there and you're dissatisfied, you sick of tired of being broke, busted, and disgusted, like you are tired, then change gonna come because you're dissatisfied. And boom, here go our opportunity. They go a financial educator that's here to guide you. They go a financial plan that you can follow. Now change is gonna come. But we have to make sure that we make our shoulds a must, right? Yeah. A lot of people say, you know what? I should stop smoking because it's not good for my health.
Right.
I should stop doing this. And so they end up not doing it because it's a should. But when that doctor come and give them a bad health screening and say, listen, because you've been smoking X, Y, and Z going on with your lungs, now that should become a must at that point, right? They just cold turkey, boom, stop smoking, right? Because it became a must. So don't let your shoulds become a must. Most people just should all over themselves, right? Like this, you don't be that person, right? You want to make sure that you turn your shoulds into your must, right? You chose your future, you're home, right?
And speaking of planning, I want to give out 3 tips. So 3 things that kind of help us get started with planning our financial future and being able to save up money to do things like invest in real estate, fix our credit and stuff like that. So the first thing I would recommend is looking at your bank statements. You can start with the last 3 months. Look at your bank statements, look at everything you spent money on and categorize it, right? Then you'll be able to see where your money is actually going. See, because today, most of us don't even carry cash. We have a debit card. So when you swipe, you're not conscious of how much you're actually spending until you go back to your bank account and then you look at your transactions, like you look at your ending balance and you're like, wait, where all this money went? I know I was like that.
You what? Say it again?
So,
did y'all hear her? This is recorded, by the way.
I'm better now. So that's what I would recommend doing, going through your bank statements and categorize your spending, right? And then analyze that and say, okay, well, instead of me getting fast food for lunch, let me bring my lunch with me. Let me make my lunch the night before. Or have your children to do it. Some people are really busy and ask your children to help you out and they would love to do it. The next thing I would say is lower your monthly expenses. So look at your monthly expenses, write it down, see what you can eliminate first, right? If you have credit cards, you want to eliminate the highest interest rate credit card first. That's the first thing you want to do. If it's your cable bill, well, you want to slash the cable bill, take away some of the channels, or go to streaming sources and devices.
Yeah.
Help you save money there.
We did that. We cut that cable bill out years ago.
We got the antenna. I told Randy, look, I need you to get on the roof and put this antenna up.
And I did.
And he did it.
And look, guys, it's not the antenna that you might be thinking about with the old fuzzy screen.
Oh no, listen, it's better than cable.
It's better than cable. That antenna is crystal clear. You get all the local channels, the news channel. I mean, crystal clear, right? Yeah, and we have our little devices that we use, you know,
for streaming. So we save a lot of money there. So what that allowed us to do was save up more money to pay off the bigger debts, like a car note. So we were able to pay off things like that. I was able to pay off my student loans eventually. I mean, I was the type of person who was conscious about how many loans I was taking out anyway, because I don't like debt and I don't like to have to pay it back. So when I was in college, I was like, wait, they offer me another loan? No. One day I'm gonna have to pay this back. So I kind of put a pause to my, decision making when I was in college. So, and the last thing I would like to say is create another savings account at another bank. So what I used to do was take my, set up a direct deposit to where I had a certain amount go to that bank account first, before I even paid my bills. It went there first. I paid myself first. So you do that and watch how your money grow. Even if you have a business, take a percentage of that amount that you make, whether it's 5% or 10% a week, a month, however you want to do it, but put that into another account. Watch it grow.
Absolutely. It's called out of sight, out of mind, right? You're not paying attention to it. It's out of your sights, but it's also out of your mind. It's just
and don't touch
automatically it's going to that bank account.
Yeah.
And also Mint, right? MINT, mint.com. It's a free app. You can download it. Veronica and I, we use this, a budget tool. Like you can connect your bank account to it and it will show, you can put a budget in and say, okay, I'm only going to spend $2,000 per month on my living expenses, right? And you could budget at $2,000. Then you could break it down by line items, right? You can have your food costs at X amount of dollars. You could have your coffee costs X amount of dollars, right?
That was in there.
Yeah, twice. You can have your gas costs X amount of dollars, so on and so forth, right? It's a line item, very detailed, right? And so now when you connect it to your bank account, when you spend at the coffee shop, right? It's gonna automatically go to that app and show how much you have left as a balance, right? So you're like, okay, I had $50 a month. I didn't spend 45, so I only got one cup of coffee left. Right? Do I want to buy it right now? Wait another 10 days to the end of the month on the 33rd, right? So that mint.com is a really good tool. You can do it online. You can set it up online, but you can also have the mobile app, right? Again, we personally use that app. One of our guest speakers last week that came on, he even mentioned that app, right? And he paid off how much student loans he paid
over $90,000.
Yep, over $90,000 worth of student loan after the first 2 years he was out of college, right? Not over 10 years, right? 15 years, after the first 2 years. And he gave some tips. So I encourage you to go back and watch that podcast. It was just last week, right? Last Tuesday. So if you're on YouTube, go type in the Mortgage Wise Radio Show and Video Podcast. If you're on Facebook, look up the Facebook page, the Mortgage Wise Radio Show Video Podcast, or iHeartRadio. Type in iHeartRadio. You can listen to it while you're driving. He dropped some great nuggets and tools on there, right? Because we was talking about the subject, how can the community pay off debts, right? People, how can they pay off debt? And he gave some good tips. He was like, listen, the first thing you have to be able to make a choice and decide that's what you want to do. Now go out there and go to work, right? And that's one of our topics I wanted to talk. Right. Go to work, right? I'm gonna hit it right now. Yes, I know you want to be a full-time entrepreneur. I get it. I know you want to be a full-time real estate investor. I get it. You want to be in cryptocurrency and be a 100% entrepreneur. I get it. But if the money is not flowing every single month like it should, your bills are residual. I don't know anybody that ever paid off a mobile cell phone bill before. Nobody.
Or energy bill,
or gas bill, water. Nobody that I know ever paid it off. Them bills is residual. They keep coming in every month, right? So if you need to go get yourself a job, go and get that, right? If you need to go get a job and have overtime, go and make that happen. If you need overtime and a second job, go and make that happen, right? If you need to start a home-based business, right? A network marketing company. If you need to start a traditional business, cutting grass, haircut, a small store, I don't care. You go and make that happen. Go get your job. And after you finish your job, duties, you go and you work your business. Why? Because it's cash flow.
That's right.
Cash flow, right? As that money coming in, you could take that money, pay down that debt.
And that's what our guest speaker said he did.
Yep.
He said once he started focusing on it, then opportunities started being created, meaning he was able to create opportunities to get extra money to go towards that debt. And opportunities were jobs or maybe businesses or selling stuff on Amazon, selling stuff on Craigslist, whatever. But that's the opportunities he said came about that he spoke about.
Right. Because
it just didn't fall out the sky.
That's right.
What I'm saying.
Whatever your focus goes, your energy flows, right? It's called your RAS system, your reticulating activating system. It's your brain secretary, your mind, your God-given secretary, right? And what that simply is that you see things that you wouldn't have necessarily saw before, right? For example, you bought that brand new car. It's a yellow convertible Corvette, right? Prior to that, you didn't see no yellow convertible Corvettes riding around. But as soon as you get that car, you see it passing you up all day on the interstate. Like, man, I want another one. Like, well, what happened? Well, your mind thinks millions of thoughts, right? Thousands and thousands of thoughts a day. So like right now, they might have a little ant calling on my door right now, right? If I focus on that, I'll go crazy because too much is going on right now. So your mind protects you to make sure you're not focusing on everything and being discombobulated, right?
Right.
But when you're focused, right, wherever your focus goes, your energy flows, your RAS system, that GPS say, boom, this is an opportunity for you to earn some extra cash. Boom, talk to that person so they could coach you through your financial situation. Boom, don't talk to that person, right? Etc. Right? And so you have to be able to be willing to go to work. That don't mean you're gonna be working for 20 years. That don't mean you're gonna be working for 5 years, 2 jobs, right? Now, if you don't follow the plan, you will. Because I mentioned that earlier. Some people pick up their second job, pick up overtime, have a business, but instead of paying off debt and being disciplined, they created a lifestyle around the extra money they was getting.
New lifestyle.
A new lifestyle. Now it's not extra money no more. It's a must now for them to work 2 jobs. And it's a never-ending cycle. Robert Kiyosaki, Rich Dad Poor Dad, call it the rat race. You're just spinning your wheel. You're a rat on this wheel, just spinning, ain't not going nowhere, right?
Yep.
So listen, let's talk a little bit about bad money habits intervention, right? Bad money habits intervention. You have to be willing to say, okay, I am not going to buy this should right now. I'm not going to buy this want right now. I need to only purchase the things that I need and spend money on my need. So you have to break that mindset cycle, right? And how do you do that? Well, we talked about paying off debts. We talk about lowering your living expenses. We also talk about earning additional income and putting towards your debts and lowering your living expenses. And we talked about ways to do that, right? So I want you to think about this. Money is time. Write that down. Money is time. So a lot of people confused what wealth is. A lot of people confused what wealth is. Wealth is not about money. Wealth is time. So if you have $100,000 in your bank account right now, and your lifestyle is $50,000 a year, then your wealth is 2 years, right? But if you have $100,000 in the bank, but your living expenses for the year is $100,000, then your wealth is 1 year. But if your lifestyle, right, is $50,000 a year, and you have a business, or you have an investment opportunity, or businesses, right, that's bringing you $50,000 every year, then your wealth is infinite. You understand? Because you're making money without working. Wealth is based on how much time that you can go without a job, without you physically going to work for the money that allow you to live your lifestyle. That's wealth. So if you think about this from a money is time, right? So when you have your lifestyle career, your financial objective, that goal, that financial plan is written down and say, okay, I want to be debt free. I don't want to owe nobody nothing, right? I want to have my living expenses low. If my mortgage payment is so cheap, I can go wash the windows on the corner and make that little mortgage payment up, right? You want to have no car notes, no student loans, all that good stuff. Your living expenses super low, right? So let's say your living expenses is only $2,500 a month, but you're making $6,000, $7,000 a month. The difference between what you owe monthly, those expenses of $2,500 a month versus what? That $6,000, $7,000 income yet, that's cash flow in the middle. Like that's your freedom, that's your time, right? So think about this. The next time you go and getting ready to spend money, you say, is this bringing me closer to being debt-free and being financially free where I can do what I want, when I want? Is this decision gonna make me be closer to my debt-free day? Or if I spend this money on this particular object, will this delay my freedom? Will this delay my freedom? So think about that. You get ready to spend $10,000 on a car on credit. That's gonna take you another 5 years before you retire from your job. You don't spend that money on that car and go buy you a quick used car, or if you don't need it at all, don't buy it. You're ahead of the game. You're gonna retire years early. And when I'm talking about retiring, I ain't talking about, an elderly person retiring. I'm talking about being financially free, where you never have to work again. Like you wasn't designed to go to work and pay debt. I don't know if you guys know that by now. You wasn't birthed on this earth for you to go to work, pay bills, and die. That was not what the Most High created you for. Through your choices and your decisions, through the environment that you've been around, from the program that you received, you think that's how life's supposed to go. But that's not how life's supposed to go. You're supposed to be free. The scripture tells us to owe no man nothing but love. It's there for a reason. If you don't owe nobody, you're not a slave to nobody. So if you think about that, just go into a vision from, just imagine yourself without no bills. Imagine yourself with low living expenses. Imagine yourself with income that's coming in. Think about it. How would you feel? Where would you go? What type of vacations would you take with your wife and your family, or your spouse, your husband and family, right? What things would you do? So I want you guys to think about that. And next time you get ready to spend that money, think about that money as your time. That's your freedom ticket. That's your freedom that you're spending. So all that said is to say this: financial fit lifestyle. You want a financial fit lifestyle. So guys, today, guys, we was talking about a subject, and is the new new FHA student loan guidelines, and also money habits intervention. So I hope you guys enjoy it. I'll see you guys in the next video. I am Randy Chambliss. I can be reached on Facebook or Instagram at Mr. Randy Chambliss. You can call me directly for a free phone consultation at 504-270-2783. And you can also find me online at randyknowsmortgages.com.
And I'm Veronica Chambliss. I'm on social media under Veronica Chambliss. My direct contact number is 504-715-4388. And I'm also online at vknowsmortgages.com, and that's VEEknowsmortgages.com.
All right, guys. So listen, God bless. Have a great day on purpose. Take care.
That brings today's show to a close.
Oh, come on!
Thank you for listening to the Mortgage Wise radio show and video podcast. If you enjoyed this episode, feel free to share it with a friend and subscribe. Please follow us on YouTube, Instagram, and Facebook at the Mortgage Wise Radio Show. If you want to learn more about what we talked about today, give us a call at 504-270-2783. Or to view our podcast library, please visit our website, themortgagewiseradioshow.com.
Autobots, roll out.
Until next time, choose to have a great day on purchase, Mortgage Wise friends.
Go home.
Go home.
All right, guys. Enjoy the rest of your night on purpose.
Good night.
Take care.